Hi, welcome everyone to the session. So this is a session for financing innovation in climate tech. I'm Chendi Zhang, Professor of Finance, also Director of Exeter Sustainable Finance Centre, moderator for the panel today. It's my pleasure to welcome our panelists today. We have a fantastic panel. Catherine Lewis La Torre from British Business Bank, Juliana Garaizar from Greentown Labs, Paul Seidler from Evergreen Climate Innovations. Okay, welcome everyone. So without further ado, let's crack on with our questions. Let me first ask question to Catherine Lewis La Torre, who is Chief Executive from British Business Bank. You have a great deal of experience in supporting small business at British Business Bank. So what do you see as sort of the main barriers and incentives for small business in innovating climate tech?
Thank you, Chendi. And I suppose the first thing to say that obviously SMEs play a very important role in the UK economy, making up 99% of our almost 6 million enterprises. And the most recent estimates suggest that these smaller businesses are also accounting for roughly 50% of business emissions in the UK. So we won't be able to meet any of our net zero targets unless we can bring our SMEs with us. What does that mean for the British Business Bank? We were brought into being really to help smaller businesses access the finance they need to grow and prosper. And in recognition of what we all need to do to have a lower emission economy, we revised our mission last year to put net zero at the center of it. And the second thing that we did was undertook a piece of research with our SMEs to try and understand exactly those questions that you were raising in terms of what are the barriers, what are the incentives for SMEs to really get on that journey to begin with. And what our research showed is that, first of all, I think most businesses are already undertaking some actions to lower the emissions of their business, but it tends to be the lower hanging fruit. And I think it's 94% of smaller businesses surveyed in our research told us that they have taken at least one action to reduce their emissions. But clearly, in terms of making significant change, we were interested in what they felt the barriers were to doing more. I think unsurprisingly for the panelists here today, the biggest barrier cited in most cases, in 35% of the respondents, was costs as the biggest barrier for reducing their carbon emissions. But there are also multiple other barriers that were mentioned, and significantly 15% of SMEs who responded to the survey said that actually they didn't know what the exact barriers were, which suggests that there's a big piece here in terms of information provision, clear information provision for SMEs as to what they can do. And showing best practices from other SMEs, we also think will be part of the solution here. What about the incentives, though? So something that came up repeatedly was this hunger, if you like, for information to help them on their way, as well as really an appetite to have clear standards or clearer standards and regulations from governments to help them set the environment well. I think from our perspective, one of the encouraging pieces of one of the encouraging findings from the research was 11% of UK SMEs had already accessed external finance to fund some activities. And a further 22% of SMEs said they were ready to use external finance to take themselves on this journey. Clearly, that's important for us as a development bank set up to improve access to finance for smaller businesses. This is one of the levers that we can pull, and one of the things that we can clearly help to support as our SMEs think about funding new business strategies to lower their emissions.
Great. Yeah, thanks, Catherine. Okay. Let's move to our next panelist, Juliana Garaizar, who is Vice President for Innovation at Greentown Labs. Okay, so Juliana, what do you say? So, are the key differences between clean tech and climate tech investing, and how venture capital funds and technologies are evolving? What do you see going to happen this year?
Sure. So, coming from the investment world and being burned in the clean tech bubble 20 years ago, I think there's plenty of differences. The first of all, climate tech is a lot broader. So in clean tech, normally we used to invest in renewable energy mainly, and the cost of those technologies were still not past the tipping point. So, it was not making any financial sense to invest in them unless they were having any kind of subsidies. And of course, many companies in Europe or California used to have subsidies. And when those subsidies ended, that was the end of the bubble for clean tech. For climate tech, first of all, it's a lot broader. So if you seek the definition about climate tech, it's really trying to reduce emissions in the most greenhouse gas emitting sectors. And that's not only the electricity, but it's also anything that has to do with energy efficient buildings, transportation, materials, agtech and water, and anything that has to do with resilience. So basically, whatever you think that is making things more efficient, is a way to abate or reduce emissions. And that's what climate tech as a broad is. And that means that in many cases, technologies that first were not passing the tipping point, like maybe solar, wind, electric vehicles, are already making financial sense, even without any kind of subsidies. And then many others that are considering climate tech, like, carbon capture or anything that makes, processes more efficient, have also more scalability. Any kind of company now that is a climate tech company is able to actually have lower startup costs and is able to scale a lot more because, they have that scalability potential that many of the previous one didn't have. There's less in terms of infrastructure, in terms of startup costs and all that. And I think, one of the things that is really important to point out is that there's already quite a few climate tech unicorns, not only like the Teslas and Impossible Foods and Beyond Meat and Nestle and many others that are there. And I think, are driving the way for entrepreneurs to figure out how to get there. In terms of how VCs have evolved, I think before, when we had the clean tech 1.0 and now versus the clean tech 2.0 or climate tech. I think before we had only clean tech funds that are very specifically investing in those. And now we have a very broad reach of VCs, and not VCs that were generic that now are interested in climate tech, but also even the private equity and other growth stage funds, and actually some corporations like Amazon and Microsoft and Unilever have created, $1 billion, or in the case of Amazon, $2 billion climate funds to investing in climate tech. So that's really different. You can also see the oil and gas companies that, before had the corporate venture arms that are now not only changing their names of the corporate venture arms to low carbon funds or new energy funds, but also making sure that they invest at earlier stages. These kind of companies used to invest in growth stages. Now, many of them, even private equity firms, are getting earlier because they see a lot of potential. Just to, put things into perspective, half of the technologies that are going to be used to get to net zero have not yet even been invented. So that's why many of these VCs, many of these investors need to get earlier to make sure that these companies get to where they need to be at net zero at a much faster pace. And that's why many are actually going for earlier stages.
Great. Thanks, Juliana. Very interesting. Okay. Let me move to our next guest, panelist, Paul Seidler from Evergreen Climate Innovations, who is the managing director for Evergreen. Okay, Paul, could you tell us your unique investment model and the role it plays in early stage financing for climate tech.
Yep. Thank you, Chendi. Thank you for having me. Paul Seidler, Managing Director with Evergreen Climate Innovations. We are based in Chicago in the United States, and we are really focused on early stage investing. We operate a rather unique investment model that we describe as a 501 VC. For those of you not familiar with US tax code, a 501c3 organization is essentially a tax-exempt NGO. And so a 501 VC, as we describe it, is exactly what it sounds like. We operate an early stage, seed stage venture capital fund structured as a nonprofit. Why do we do this? We are structured this way very intentionally to be able to bear a little more risk than the market, so we can invest a little bit earlier and invest in innovations that we see as being very promising, but aren't quite ready to take on private capital, where it's just maybe still a little too risky for private investors. So we serve as either a first money into a startup, or kind of bridging from a friends and family and angel round to an institutional round. Our fund is, to explain a little bit more how the mechanics work, our fund is fully capitalized with philanthropic dollars. So we don't have LPs or investors in our fund, we have donors. We then make direct investments. The fund is structured as a revolving evergreen fund. So the dollars that we see from returns from our investments just get recycled back in the fund and redeployed. Our vision is that if we make enough of the right investments over enough time, that our fund can grow and self-sustain on its own without us having to continuously go out and raise more philanthropic funding. So our pitch to donors is really the idea of compounding impact, that we want to put your money to work over and over again, not just once. We've invested in 38 startups over the last 7 or 8 years now. We've seen 5 profitable exits where capital was returned with a strong return and redeployed back through the fund. We're broadly focused on climate tech and clean tech, and really any promising innovation that has the potential to make a meaningful difference.
Great. Yeah, thanks, Paul. Right. So let's now have an open discussion around a few questions, right? The first question for the panel is, what do you see the new trends in financing for climate tech? So let me ask a question to Catherine, please, and then I will ask this to other panelists as well.
Thank you, Chendi. And I think Juliana has already touched on some of this. But one of the things we expect to see more of is more patient capital type investing, going into clean tech. And Juliana talked about the sort of first interactions with patient capital investors in clean tech. But my very strong feeling is that the huge investment opportunities for the next decade are going to be around climate change abatement. And we will see investors naturally moving in that direction. In fact, we've already started to see it. If we look at our own portfolio, we have a commercial subsidiary called British Patient Capital, which invests across a range of different strategies and different sectors. But we estimate that around 10% of our portfolio is currently exposed to what we call green tech opportunities, whether in clean growth, sustainability, or mobility. We think that number will increase automatically in the coming years. The question that we're asking ourselves is, do we want to set ourselves a more ambitious soft target, if you like, as to the amount of exposure that we want to have here, as opposed to other sectors where we also want to have and do have exposure, such as life sciences, for instance. So we think it's a trend that's already underway. I think that investors are indeed trying to find the right routes into these opportunities, and they'll be looking to participate at different stages in the funding journey. But we can only see a growing role for patient capital, and we would expect to be very much leading that trend.
Great. Thanks, Catherine. Juliana, anything to add? And then Paul, please.
Sure. Climate tech investing has been raising to 16 billion, has been growing for the past 7 years, more than 4,000%, even the bigger growth than the AI investment hype. So it's clear that it's here to stay. Greentown Labs is an incubator. We are the biggest climate tech incubator in the US. We are based out of Boston, but we're open also here in Houston, where I lead the incubator. So we have access to a lot of investors. We don't put any equity ourselves, and the trends we are seeing in terms of requests that we're seeing a lot of investors asking for deal flow in hydrogen. Hydrogen is getting pretty big. Also, anything that is related to carbon capture. Bioplastics, and anything that has to do with circularity is key, and of course agtech and water. And with agtech, water, and also anything that has to do with carbon capture, there's a real intersection between, of course, hardware, but also anything that has to do with biotech. We have one of our companies, Senvita Factory. They're doing carbon capture by genetically modifying microbes, and I think that's key. Playing at those intersections. Investing in data is also key. So anything that has to do with AI or IE to be able to, put the carbon footprint and account for carbon footprint. And also we can see a lot of investments into accounting for carbon capture or anything that has to do with blockchain too, in terms of, tracing the sustainability factor for the supply chain and many others. So those are the key areas we see.
I think Juliana just touched on a lot of the hot trends that we've been seeing as well. Direct air capture, certainly carbon markets. Carbon markets are really starting to thrive, even though they're mostly still voluntary markets, but the price continues to rise. On the data and software side, broadly, what I would describe as carbon intelligence is very much a hot trend, but there are certainly some underfunded sectors as well, which maybe we can get to later.
Okay, thanks, Paul. So do you see there is a role for public sector and sort of private sector to work together in sort of, financing climate tech?
Should I take that, Chendi? Thank you.
Yeah.
There absolutely is. I think the public sector can be, leading the way in terms of setting the overall environment, but this is going to be funded by the private sector substantially. So we find ourselves at the British Business Bank at a very interesting intersection, we think, between the government and finance markets. And I think we're very clear that it's going to take both the public and the private sectors working together to achieve the degree of change that we need to bring about here. So I don't think it's either or, it's both. And I would say public, private, and third sectors. I was incredibly interested in Paul's model, and having some intersectionality in that way, I think, is going to drive a lot of the change, especially at the inflection point that we're at now, where the risk appetite perhaps for some mainstream investors isn't quite there, but we can do some things to crowd in private capital to lower the bar for bringing extra dollars into this space.
Okay, thanks, Catherine. Okay, so let me address my next question to Paul, please. So do you see trade-off between financial returns and impact in the space of climate tech investing?
Well, I guess I reject the premise of the question in certain ways. I think categorically you can't really just say that there is a trade-off between climate impact and returns. I think that it's something perhaps on a deal-by-deal basis, but I think that each investor needs to ask the question, what's your objective? What are you optimizing for? And you can be optimizing for, you can choose to optimize for impact, you can choose to optimize for financial returns, you can choose to optimize for both, and that can be done. I think that you can talk about having more patient capital, but you could still we still look for venture type returns as in terms of multiples, cash on cash multiples, but we do inherently have patient capital because we don't have LPs requiring money to be returned in a certain timeline. But you are sacrificing on IRR. If you extend your time frame, let's say you want to be more patient, your IRR is going to go down. So you have to take these things into consideration, and ultimately capital allocators need to ask the question, what is their objective? What are they optimizing for? And I think it has to come from the top down, starting with LPs and the capital allocators at the very top. And what are their requirements? What are they asking for from their fund managers in terms of impact, returns, and measuring and reporting that impact? So to answer your question, Chendi, it depends.
Great. Okay,
Chendi,
how about Juliana?
Sorry,
right,
could I come in on that? Because I think
please.
what Paul has just mentioned is really key. But I think the trade-offs are more likely to come for the companies themselves. And this is something that we've been looking at with the SME community in the UK, because undoubtedly there will be winners and losers in this whole transition, especially because if you think about where SMEs sit in supply chains, lower emission solution is going to be driven by their customers. And I think for SMEs not able to respond to that request, it could be, if not existential in the short term, over the longer term, it will be. So I think that's where the trade-offs come in terms of, do I make the investment now? And how do I make that investment in order to position my business for the long term?
I agree. I think timing is of essence. Do you continue with your cash cow or do you start transitioning? And I think that's not only the question for SMEs, is a question for many of the oil and gas companies that are now, many of them started transitioning a while ago, but are taking this much more serious approach. I think in terms of, impact versus returns, if you take the long-term approach, there's a very strong correlation between, doing the right thing and, having the desired ROI. So depending on how you look at it, if you are investing for the long term, we really believe that the companies that are investing to change and to transition are going to get the results later on. So, if that's your kind of time frame, I think, there's no trade-off.
Okay, thanks. So what are the hot sectors for delivering both returns and impact, and what are the underfunded ones? Any views on these? Maybe I'll start with Paul.
Well, we touched on some of the hot sectors earlier with direct air capture and carbon markets and carbon intelligence. I think another one, alternative proteins, has been pretty hot. I think it cooled off a little bit, but I think it's actually going to pick up again soon with sort of a second wave of innovation coming. I think the underfunded sectors are the ones that are really tough to decarbonize. It's hard to find these solutions. So we're talking about industrial process heating, steel production, cement production, very tough to decarbonize. And I think, and food systems broadly, but I think that a lot of these sectors are going to be addressed through categories of technology like synthetic biology that's just starting to get into the climate tech space in a big way and has a huge amount of potential in addressing sustainable food and nature-based carbon removal solutions. I think electrochemistry has a big role to play, has done incredible things in energy storage, and now is being applied in cement production and steel production in really interesting ways. So I think those are sort of broadly the underfunded sectors. They are starting to get some attention, but we need way more funding at the very earliest stages.
Thanks. Anyone want to add?
Yeah, I will only add, the hard to abate transportation sectors, like, anything that has to do with shipping or airlines, they can go electric because they're too big. So we still need to figure out solutions there. And it's a lot of them are system problems, and I think that's when we come also to hydrogen. It's not only that you need to fund the technologies, that you need to fund the infrastructure, and that's when it becomes a little more complicated, and you need to find the funding for those.
And I would just add, I think, in terms of not so much sector by sector, but where does the funding crunch really come? Because our observation would be that actually finding the capital to start some of these businesses is probably available, but finding the capital to really scale these businesses is where you hit a bit of a roadblock. And we set up a direct fund last year called Future Fund Breakthrough to support R&D intensive companies, especially at the later stages, where you really have some, very good proof of concept, but you need a very big check to take the business to the next stage. There aren't enough investors right now ready to write those big checks, and that's something that, again, we think that hopefully we can crowd in capital into those later stages by committing capital ourselves. So with Paul's model, trying to bring public sector funding in at the right point to galvanize and catalyze the private sector.
Thank you. Okay, let me ask my last question to Juliana. So what do you see the main sort of development in terms of transforming climate tech research technology into entrepreneurship and successful business?
So in general, going from any innovation that would come from a university to go to a place like Greentown and then, getting acquired or adopted by the industry has taken 10 years. And I think that needs to change if we want to make sure that we get to net zero by 2050. And one of the big things that I think is crucial is to get technology commercialized much faster. And that means technology needs to get transferred faster. And then, we need to adopt the technology faster. So I think in terms of technology transfer, one of the biggest I think, misalignments there is that faculty has not been incentivized to, just get technology out of the universities. And, that's the case for many universities. There's a few examples like Carnegie Mellon, where you actually don't get penalized and you don't lose tenure if you decide to do a spin-off. And some of the faculty there have actually created 10 spin-offs with PhD students and, getting a lot of technology out there. But in general, there's a trade-off. You either continue with your tenure or you just step out and have to, basically forget about that and do your startup. And that's a huge cost. Then once the technology is out, I think adopting technology by big companies is also needs to go faster. And I think that's where we all need to start figuring out how to get and adopt more technology. And one of the things that we're trying to do at Greentown is establish pilots. Many of the partners that we have a lot of infrastructure with a lot of the new technology in climate tech can be tested and piloted. And that's kind of the chicken and egg problem for many of our companies. They cannot get funding if they don't prove that they have a working pilot with a, credible industrial partner. And I really believe that companies need to be testing and sometimes, try fast and fail fast too, so that we can get the technologies that are really going to work and revolutionize our systems. And this is going to be a full system reboot, and many of the technologies need to be proven as soon as possible. So I think that these two things, both the tech transfer and the pilot side, are going to be key to make sure that we take less than 10 years to bring all these technologies to market.
Excellent. Who want to add anything to this topic?
I think that innovation is just so critical. And we talk about innovation, we're always talking about technology, but we need innovation at every level of the ecosystem. What Juliana was just talking about, mentioning Carnegie Mellon, that is innovative that they allow their professors to do that without losing tenure. And we need our government to think with innovation, and we need, at every level, federal, municipal, state, we need innovation. We need our philanthropic community to think more innovatively. And I think this is a key to moving faster, is working together in new innovative ways.
And something else I would add to the debate, I think, is the role that business angels can play, certainly in the commercialization, in working together with professors and PhDs to show them the way to take that technology out into the market, to make it into a package that becomes attractive for the mainstream VC community. And that's something that we've seen work very, very effectively in the UK. We also support a regional agenda here where we support networks of business angels across the country that are located close to our universities, that have incredible science and technologies that are just, sort of waiting there to be spun out. And to Juliana's point, yes, we need anything that can shorten the time frame to get research and technology out of the system into a shape where it can be backed by the mainstream financial community, is going to be a big benefit for the economy.
Great. Thanks, everyone. Thanks. Oh, excellent panel, Catherine, Juliana, and Paul. It's a great discussion. Well, also thanks for the audience for listening to the panel. Yeah, please stay tuned for the next session, next panel. See you.